Hello everyone. In this video, I'll be discussing the accounting for income taxes. Let's start with the preliminaries, shall we? There are actually two sets of books, the financial statements and the tax books. And hence you will hear the terms book income and tax income to differentiate the two sets of books. And we'll also talk about how tax expense differs from taxes payable. And we'll introduce the concept of deferred taxes. So why two sets of books, you ask? Financial statements serve a completely different purpose than the tax books. The net income that comes from the financial statements, also called book income, is designed to measure a firm's performance, and it follows typically the GAAP. The taxable income, on the other hand, is intended to generate taxes for the government, and it follows a tax code that is designed to reward certain kind of behavior. For example, the tax authorities may give tax credits for R&D investments to boost such investments. They may accelerate the depreciation to motivate investments in physical assets and so on. Let's talk about the important components of tax accounting. The first one is the income tax expense that is recorded in the income statement. This is like any other expense. And this is the amount that a firm economically owes the tax authorities based on the income that is generated during the period. The income taxes payable, which is a liability, is the amount that the firm actually owes the tax authorities for the period. The income taxes paid is the amount that the firm actually paid in cash to the tax authorities. And lastly, we'll also talk about deferred tax assets or deferred tax liabilities, and this is the amount that the firm deferred in taxes from one period to another. And we'll talk about that with examples. Now, because we have two sets of books, there are differences. And we can categorize them into two types. The first one is the permanent difference. And let's use an example to illustrate that. Let's say a firm has interest income from municipal bonds that are tax exempt, meaning they are not taxable from the tax authority's point of view. In the financial statements, of course, you have to record the interest income because this is income generated, and that will result in an increase of net income. However, in the tax books, these interest income will not appear because they will be excluded because it is non-taxable according to the tax code. It will never appear in the tax books ever. So the financial statements and the tax book will always be different with these permanent differences. That's why they are called permanent differences. The next type, as you would have guessed, is a temporary difference. And let's illustrate with an example here as well. An example would be depreciation. In the financial statements, the income statement will reflect the depreciation expense based on the method chosen by the firm to reflect the economic use of the asset. For example, it could be a straight line depreciation or an accelerated method to reflect the economic use. In the tax books, however, the depreciation expense will be based on the tax code depending on the type of the asset, and the tax code will specify how much depreciation for each year. While the amounts may be different each year, the total amount of depreciation over the life of the asset will be exactly the same in both tax books and financial statements. That's why these are called temporary differences. Now let's talk about the income tax expense. The income tax expense is the amount that the firm economically owes the tax authorities. In other words, the income based on the financial statements multiplied by the tax rate is the amount that the firm economically owes the tax authorities. However, when determining the income based on financial statements, we will have to exclude the permanent differences. Why? Because the firm will never ever pay taxes on these items. So let's talk about the effect of permanent differences in a little bit more detail. One, it affects the income tax expense, that is the amount economically owed to the tax authorities. Because the item is never included in the tax books, but included in the financial statements, the firm will exclude this amount when determining the economic taxes that are owed by the firm. In other words, book income, without excluding the permanent differences, multiplied by the tax rate is the income tax expense. So in our example, if the firm had no non-taxable bond interest income, the tax expense would be income before taxes, excluding bond income, multiplied by the tax rate. Now let's talk about the effect of temporary differences. They do not affect the income tax expense because what is economically owed is not going to change, because the tax books are different from the financial statements only temporarily. That is the reason the firm that economically owes the tax authorities will not change. Therefore, it does not affect the income tax expense. Rather, it affects the amount is owed immediately to the tax authorities. Sometimes the firm will owe more, sometimes it will owe less, and therefore this results in an asset or a liability, which we'll discuss in a minute. Now let's talk about the effects of temporary difference with the help of an example, shall we? And we'll start with the deferred tax liability. And we know that the firm used an appropriate method of depreciation to reflect the economic use of the asset. Let's say they use straight line method. For tax purposes, however, the method of depreciation is determined by the tax code. That is, for each asset, there is a depreciation amount by year, and usually the amount is much greater in earlier years to motivate firms to invest in physical assets. So let's take an example to illustrate this. Let's take a financial statement where the income before depreciation and taxes is $10,000. And let's say the depreciation amount is $1,000. So the income before taxes is $9,000, and let's say the tax rate is 20% to keep it simple. So the income tax expense is $1,800. By that, the firm economically owes the tax authorities $1,800. However, in the tax books, we begin with the same income before depreciation and taxes. However, the depreciation expense is $1,500 because the tax code says, hey, you can take a bigger deduction in the first few years. So the income before taxes is now $8,500. So the tax actually payable to the tax authorities is only $1,700. So you can see the tax expense is not equal to taxes payable. In fact, the taxes that are payable is less than the amount actually economically owed. So when a firm owes more than what it is actually economically owed, so you can imagine there is a liability in the books, which we'll discuss in a second. So let's talk about the accounting effects. So in the above example, the tax expense, which is the economically owed to the tax authorities, is $1,800. However, the firm is required to pay only $1,700, which means what? The firm has deferred the payment of $100 to a future year. So let's do the accounting for this particular effect of temporary difference. So we know that the firm economically owes $1,800, so it will reduce net income by $1,800 because you record an expense, which is the income tax expense of $1,800, and it will flow through to retained earnings, resulting in a reduction of retained earnings. And we also know that the firm economically owes IRS $1,800. It is going to only pay them $1,700, or it is going to owe immediately only $1,700. So the income tax that's payable out of this $1,800 is only $1,700. It is not that they will get away with the remaining $100. They are just going to pay later. So this results in another liability. We call this deferred tax liability because the firm is saying, I will pay it later. So that's why we have $100 in deferred tax liability. Now the balance sheet equation actually balances. Now the firm will present this information about taxes on the balance sheet as follows. So you'll have income taxes payable of $1,700 and deferred tax liability of $100. Now let's take the case of a deferred tax asset with the help of an example. We all know about bad debt expense. Firms have to record a bad debt expense, which is based on the estimate of uncollectible with respect to its receivables. For tax purpose, however, the tax authorities usually say that bad debts are not tax deductible. What they allow you to deduct is only when the firm writes off a receivable as uncollectible. So there is a difference between how the firm records the bad debt and how the firm records the write-offs. So let's take the example further. So let's say the firm has income before uncollectibles and taxes of $10,000. And the bad debt expense is $2,000, which means the income before taxes is $8,000. So the tax expense at 20% tax rate is $1,600. This is what the firm economically owes the tax authorities. In the tax books, however, you can see that only write-offs are allowed. So we start with the same $10,000 of income before uncollectibles and taxes. The IRS allows a write-off deduction, which is say it's $1,000, which is not the same as the bad debt expense. So now the income before taxes in the tax books is $9,000, resulting in a tax payable of $1,800. Here again, the income tax expense is not equal to the income taxes that are payable or owed to the tax authorities immediately. The opposite is true from the previous example. Here, the tax that is owed to the tax authorities is $1,800, which is more than the economic owed amount of $1,600. So this results in a deferred tax asset, which you'll see with the accounting of this temporary difference. So in this above example, the tax expense is $1,600, which is what the firm economically owes, but it is paying more. which means it has paid something in advance, so which they will recover at a later date. So let's see the accounting to understand this better. So what the firm economically owes is $1,600, which will reduce net income, which will also reduce retained earnings. What it owes the tax authorities now? $1,800. So that'll result in an increase in income taxes payable of $1,800. Now you can see the balance sheet is not balancing, but the tilt is towards the asset side of the balance sheet. So we know that we have overpaid, resulting in a deferred tax asset of $200. Now the balance sheet equation balances. Now let's look at the balance sheet presentation in this case. We will have a deferred tax asset of $200. We'll have an income tax payable of $1,800. So net you can see the economic effect of how much is actually owed by this particular firm. Let's summarize what happened with these transactions. When the firm pays the tax authorities more than what they economically owe, they simply overpay, leading to a deferred tax asset. When the firm pays the tax authorities less than what they economically owe, they underpay, leading to a deferred tax liability. And as we have seen in the case of depreciation and bad debt expense, different items will lead to either a deferred tax asset or a deferred tax liability. Now, what happens to these deferred tax assets and deferred tax liabilities? Each item that leads to a deferred tax asset or liability will reverse over time. Remember, these are temporary differences, so they're all going to adjust over time. In other words, the deferred taxes and deferred tax liabilities of these individual items will reverse to zero over time. But remember, each year, a firm will have new items for deferred tax assets and deferred tax liabilities.